After much anticipation, the European Central Bank president didn't disappoint and revealed his new bond buying plan last week. Responses from the markets were overwhelmingly positive. The euro surged across the board after the ECB press conference and was up 1.89% against the dollar, 1.76% against the yen and 1.29% against the Aussie over the week. These three were indeed the largest moving pairs. European equities were broadly higher, in particular with the DAX closing at 7,214, breaking through this year's high of 7,194 made back in March. Spanish 10-year yields closed at 5.63%, way below last week's close of 6.86% and also sharply lower than the 7.62% made back on July 25. Italian 10-year yields closed at 5.058%, comparing to last week's close of 5.850% and 6.60% made on July 24. There was additional support to the euro on rumours that the Swiss National Bank would raise the euro Swissy floor to 1.22 from 1.20. Technically, last week's development in euro-US dollar indicates that the medium-term downtrend from 1.4939 is likely completed at 1.2042, and we are now looking at a further rally through the 1.3 psychological level in the near term. Euro-Japanese yen managed to close above the 100 psychological level and is targeting the 101.62 resistance to confirm a reversal. Euro-sterling also broke through the 0.8 psychological level as well as an important channel resistance, which suggests a further upside to at least a 0.8152 resistance. Euro-Aussie's near-term uptrend continued last week, and even though some setback was seen after hitting 1.2391, current developments do favour more rally in the near term. So broadly speaking, the euro should remain bullish in the near term, and there is possibility of a medium-term reversal in most pairs. To recap, the ECB left the main refinancing rate unchanged at 0.75%, compared with the expectations of a rate cut of 25 base points. Policymakers believe that this is not an appropriate time to lower interests as economic weakness has been anticipated. Meanwhile, President Draghi stated at the press conference that officials have basically agreed on an unlimited bond purchasing program. Despite objections by a member, the program is expected to be able to help address severe distortions in government bond markets which originate from, in particular, unfounded fears on the part of investors of the reversibility of the euro. According to Draghi, purchases would be fully sterilized, suggesting that the program will not trigger inflation pressure. The ECB also affirmed that purchases would not have seniority. In the US, equities followed global optimism with the S&P 500 jumping to a new 2012 high of 1,437.92. However, the picture was somewhat clouded after a disappointing non-farm payroll report on Friday. The Dow has indeed struggled to gain ahead of the 2012 high of 13,338.66. The NFP grew a mere 96,000 in August, compared to an expectation of 127,000. The prior month's figures were also revised down from 163,000 to 141,000. However, the unemployment rate did improve to 8.1%, thanks to the fact that 368,000 Americans left the labor market. Did the NFP data raise the possibility of QE3? Yes, it seems so, but the data didn't seem weak enough to warrant anything anytime soon. The relatively limited strength in stocks post-NFP was a reflection of this. 10-year yield struggled to find a direction after a volatile day on Friday, which ranged at 1.589% to 1.733% and closed in the middle at 1.661%. Though, gold's strong rally to close at 1,740.5 seemed to be a sign that markets are buying into QE3. The Bank of Canada left the policy rate unchanged at 1% in September. Moreover, policymakers indicated for the fourth time that some sort of stimulus may be withdrawn if the economic expansion continues and the current excess supply in the economy is gradually absorbed. Few surprises were delivered in the accompanying statement despite some disappointments in the central bank's assessment of the domestic economic developments. Policymakers described inflation as softer than expected in recent months, while growth is decelerating somewhat more quickly than expected. The Canadian dollar was also supported by a solid employment report, which showed 34,300 growth in August, while the unemployment rate was unchanged at 7.3%. As widely expected by the market, the Reserve Bank of Australia decided to leave the cash rate unchanged at 3.5% in September. While acknowledging that risks to the global economic outlook were skewed to the downside, there were no hints on when another rate cut would be adopted. The meeting statement was largely the same as the previous one, but it delivered slightly more hawkish comments about domestic economic developments. The Bank of England left rates unchanged at 0.5% and maintained the size of the asset purchase programme at £375 billion. A brief statement was released with no details. Focus will turn to minutes to be released on September 19th. Looking ahead, the Federal Open Market Committee meeting will be a major focus this week. Chances of additional easing are low at this meeting, but markets will look for hints on the Fed's view on recent developments and the timing of additional stimulus. Also, the Fed will release their latest economic projections. The Swiss National Bank's meeting will be another focus as the sleeping euro, Swissy, finally made some real development last week, largely due to the ECB's bond purchasing plan and also due to rumour of a floor raise. Will SNB be so tactical to raise the floor at such a time when safe haven demand drastically reduces after the ECB's announcement? We'll see this week.